What's going on, everybody? Welcome back to the third part of this six-part series on becoming your own bank with Index Universal Life. On the last part, we talked about the cost, the fees, and the charges. Now that we got that out of the way, let's talk about the fun part. How do we access the cash value from the life insurance policy? And we do that through loans. Some companies have really good loan flexibility. There's other companies that don't. So basically what I want to do is break down the three different types of loans that you're going to see, as well as what you should look for when you're looking at an Index Universal Life product. So with that being said, let's go ahead and get started. All right, so to keep this as simple as we can keep it, there's basically two types of loans that you can take from a policy. It's either going to be a participating loan or it's going to be a non-participating loan. I don't care what insurance company it is, what insurance product it is, whether it's whole life, Index Universal Life, whatever, the loans are going to either be participating or non-participating. So what is a participating loan? A participating loan is a loan that allows your money to continue earning compounding interest as if you never took a loan from the policy. So for example, let's say you had 100,000 in your policy and that was the cash value. And let's say you wanted to take a loan out of 50,000. Well, even though you take a loan of 50,000, the insurance company is still going to credit you on the full $100,000 as if you never took a loan out. That's called a participating loan. Whereas let's say if you take a non-participating loan, same scenario, right? You got 100,000 in your policy, and let's say you want to take a loan of 50. Basically what happens is they're going to take the 50,000 from the cash value, and they're only going to credit you on the $50,000 that's remaining in the cash value for the year. So ultimately, those are the two types. So let's say if you're using like infinite banking, or if you're trying to leverage cash value, typically you want to use a participating loan because you want that full amount that you built up into the policy to continue working for you as if you never took a loan out, right? Now, that's also a little bit more risky, whereas a non-participating loan is less risky. What do I mean by that? And I'm going to do that here in a moment. Okay. Now, before we hop into the examples, I want to give you just a general idea of the different types of participating loans. All right. So we're going to work through this chart left to right. And as you can see, accessing your cash value, you can access or borrow money from your policy at any time you want to create a tax advantage distribution, even before the age of 59 and a half. So as we look at this particular policy's loan options, and 99 times out of 100, IULs will give you both options. They're going to give you either a participating loan or a non-participating loan option. So we're actually looking at a product that gives you this option. All right. So you have your fixed interest rate loan. This is a non-participating loan. Whereas these other options over here, these are what you would call participating loans. So first things first, let's take a look at the fixed interest rate loan. Again, this is going to be a more conservative loan. So basically what happens is they're going to transfer the money that you borrow from the indexed account or the fixed account allocation that you selected for your policy. And they're going to move that money into a fixed loan account. Once that money goes into the fixed loan account, they're going to charge you 4%, and that will never change, and it'll be just 4% constant. And then they're going to credit back 3% if you take a fixed loan years 1 through 10. If you take a fixed loan beginning in year 11, they're going to credit back 4%. So what does that mean? Well, if they're charging you 4 on your loan money, and then they're crediting you back 3, that means it ends up costing you 1% for the year to borrow that money. And that's anytime you take a loan out years 1 through 10. Now, let's say if you're taking a fixed loan out in year 11 and moving forward, then they're crediting back the 4% they're charging. So it's basically a 0% loan or interest-free loan, if you want to look at it like that, right? So when I say that this is the most conservative loan, it's basically because you're contractually guaranteed to be able to borrow at a 1% loan rate or a 0% loan rate for the lifetime of the policy. Now let's take a look at the participating loans. So with a participating loan, it'll either be broken down to indexed or variable. This company just happens to have both. Some companies just have fixed or index. Other companies just have fixed or variable. This particular company just happens to have three. Some companies even have four different loan options, which is crazy. But ultimately, how does this work? In your IUL, you can either choose a guaranteed fixed return for the year, usually 4%, or you can choose for index returns for the year, which means you'll earn anywhere between 0 or 10 for the year. Or you can do a blend of both, meaning you can do half of your money in fixed and half of it in the index, and you just get whatever it gets or returns. When you take an index loan, they're going to transfer the money from the current fixed or indexed allocation, and they're going to put it in an indexed loan account. All right. Now, once that money goes in the index loan account, your credit or your return for the year on your money is going to be tied directly to the performance of the index loan account. And that generally is the S&P 500. All right. Each company is a little bit different, but generally the index loan account is the S&P 500. But then they're going to charge you 5% on the loan, and that remains constant, and that is contractually guaranteed. So the advantage for the participating loan is, hey, even if I borrow money from the policy, that money is still participating in indexed crediting or growth. So the good thing is you can make up to 10%, which means if your loan is 5 and you make 10, that means you made 5% on the loan, right? But on the flip side is, let's say if the return is 0 and the loan rate is 5, well, then the loan costs 5 for the year. Still not bad considering where interest rates are. That's still pretty low. Now, lastly, we have the variable interest rate loan. So this happens to be my favorite type of loan. And the reason for it is because when you take out a variable loan, however you have your money allocated in your IUL policy, whether it's 50% fixed, 50% indexed, whether it's 100% fixed, whether it's 100% indexed, whatever it is, the money remains in your current strategies. What the insurance company is going to do is they're going to charge you an interest rate based on the Moody's corporate bond average. And it'll be up to a maximum of 1% above the current fixed account rating. So what does that mean? It means this loan rate will go up and down each year. So that means it can be a little bit more risky. However, there is a soft cap, and that cap rate is 1% above what the fixed rate is paying. This particular policy just happens to have a fixed rate of 4%, which means what? Well, if we go 1% above that fixed rate, we're right back at that 5%, right? And actually, if we're being 100% accurate, this particular company here, the variable loan rate is 4.5%. So it's actually a half a point lower than the index rate. And it can be as low as 3%. And that's why I actually like the variable loan rate, because typically you'll be able to borrow anywhere between 3 to 5% per year. So that's powerful considering the fact that you can average 6 or 7% a year, right? So that's the different loan types. Now I want to break this down and just give you a mathematical example to give you a visual or a picture to go along with this. So let's say you have $100,000 of cash value and you want to take out $50,000 as a fixed loan. Here's basically what it would look like. So you have 50,000 here, and then you'll have 50,000 here. The difference of these being this is loaned money and this is unloaned. So let's say that this loan rate is 4%, 50,000 at 4%, that equals $52,000 loan balance. Now, remember, within our cash value, within the index universal life policy, typically we can average about 6 to 7% a year. For this example, I'm just going to use 6%. So that's our rate, okay? Now, what happens is, remember, in the fixed loan, they're going to charge us 4%, but this $50,000 that we loaned, we earned 3% interest on it, bringing the balance to $51,500. And then we'll continue to earn our average of 6% on the unloaned money, bringing the balance to $53,000. So if we're looking at the total, 53,000 plus 51,500, that brings the cash value to $104,000. $100,500. All right. So not bad. Even though you borrowed money, you still made money because we got $4,500 more in cash value than what we started with, even though we took a loan, right? So that's a fixed loan. And again, that's the more conservative way to access the money. Now let's talk about a riskier, but a more rewarding way to access money. All right, so we're going to have the same cash value of 100,000, and then we're going to have a index loan, because remember, index and variable, they operate basically the same way. But for this example, we're just going to use the index loan at 5%. So same scenario, you want to borrow $50,000. You got 50,000 here. This is your loaned money. And then you got 50,000 over here. This is your unloaned money. And they're going to charge you 5% interest on the $50,000, bringing your loan balance to $52,500. Now, here's where the opportunity lies, because even though we borrowed this $50,000, the insurance company is still going to allow that full $50,000 to participate in the index crediting, right? So assuming we average our same 6%, that means we make 6% here on the loaned money and 6% on the unloaned money. Meaning what? We have 53,000 here and 53,000 here, bringing our cash value to what? 106,000. All right. So for the same scenario, but just different loan options. So to recap, option one, we choose a fixed loan. Again, it's the more conservative loan, and our cash value is at $104,500 at the end of the year. Or we can take a riskier loan, the index loan, and pay a little bit more interest, 1% more interest at 5%, and our cash value equals $106,000 at the end of the year, right? So that's ultimately where the opportunity lies. That's an extra $1,500 in the same scenario, all right? One thing that I would say that you want to be careful about, let's say if you're going to be accessing the cash value from a policy frequently, and this typically will happen in retirement, or like if you're a business owner and you need operating capital and you're looking to use the cash value right away, whether it's for real estate or whatever, flexibility in loan options is key. Because if this loan rate is at 5% each year, and we know that we can earn anywhere between 0% up to 10, we're looking at an average of 6, but there might be some years where you only earn 1 or 2 and your loan rate is still 5. There's going to be other years where you earn 10 and your loan rate is 5. Now, let's say if there's consecutive years where you have zeros, fortunately that has not happened, not saying that it couldn't. What you want to have is a fail-safe, a mechanism built into the policy that allows you to be able to switch from an indexed or a variable loan to the safer fixed loan, where you can borrow at 1 to 0% without having to pay the loan back. So that's why if you are looking at a policy, particularly an indexed universal life insurance policy, the ability to switch your loan option or your loan type is very important. Why am I mentioning that? Well, there are some insurance companies that will not allow you to go from a fixed loan to a variable loan unless you pay a loan back or the loan back. And that may not be feasible sometimes, right? There are some insurance companies that won't allow you to go from a variable loan to a fixed loan without paying the loan back. There's even some insurance companies that will let you switch from fixed to variable without paying the loan back, but they might make you wait 12 months, meaning you can't take any loans for 12 months before you can switch or convert that loan to the other type. There's other companies that give you the option, and that's why I want to highlight here. They give you the option to switch between loan types once per year. So why is that important? Well, let's say if you don't think the market is going to outperform the loan rate, well, you may want to opt for a fixed interest rate loan for the year, where you're guaranteed to borrow at 1% or 0, depending on how long you have the policy, right? Feeling a little bit more bullish about where the market is heading, then you might want to go from a fixed interest rate loan to an index or variable interest rate loan, right? And this is something that you can choose and go back and forth with really at any point in time, depending on the carrier. There's even some companies that allow you to have a combination of fixed and index loans at the same time, right? So you can have 50% of your money in a fixed allocation loan and 50% in an index allocation loan. So you can get really, really creative and crazy with it. There's a lot of different IUL products out there. And if accessing your cash value, there's a lot of great IUL products out there. And if accessing the cash value from the policy is something important for you, then I strongly encourage you to look for a policy that gives you the ability to switch from a fixed loan to a variable or index loan without having to pay that loan back or without having to wait 12 months in order to do it. Right.
So that brings us to the end of the third part of this series. On the next part, we're going to start looking at some of my favorite IUL products that are on the market going into 2025. And why am I saying 2025? Because we pretty much done with 2024. And a lot of companies are now starting to roll out new IUL products. Man, I wish I would have waited and got a policy based off of some of the new features and some of the bonuses and options that they're rolling out now. So if you are looking at getting an IUL and you want to know what products are good, what companies are good, I'm going to start rolling out over these next 3 videos, the companies that I actually like, who I think do IUL right. I'm talking about charges. I'm talking about loan options. I'm talking about financial stability. And most importantly, I'm talking about the insurance benefits. If that's something that you don't want to miss, make sure you go ahead and click that subscribe button, and I'll see you on the next video.